From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, January 6th, and you're listening to the Macrocast, brought to you by Penta and Markets Policy Partners. I'm your host today, Bryan, a partner here at Penta, joined as always by John Fagan and Brendan Walsh of Markets Policy Partners. And today we also have my colleague, Penta's President Matt McDonald, here with us to discuss Jobs Day. Matt, welcome back to the show.
Thank you.
This is technically a new season for us, season 5 of the Macrocast. Amazing how time flies. And we're coming into 2023 on a pretty wild note, both with some of the economic conditions we'll discuss in a second, as well as a lot of the political happenings here in Washington this week with the speaker's race. And we'll get into later in the show what that means for kind of the rest of the year and the Fed and the debt ceiling and a whole bunch of other issues that are likely to have a major impact on our economy going forward. But why don't we start with jobs, another strong report from December. Matt, why don't you walk us through what you saw there today?
Yeah, it was a great report. Bit of a Goldilocks report for looking at a labor market that's holding up and a Fed that's trying to get inflation under control. We had 223,000 new jobs in December. The unemployment rate went down to 3.5%. Two things to look at, and I should note there were some revisions along the way that were generally kind of positive for what you're looking to see. But I really want to kind of focus in on two pieces under the hood on the report. One is the wage growth and hourly earnings number, and then the other is the labor force participation rate. So when you think about this, what the Fed wants to see is a more moderated labor force where there are more people joining the labor force, where the wage pressures are going down. I mean, the wage price spiral is a big driver of inflation. And, while it's nice for wages to go up, one person's wage is another person's price. That's the way the economy works. And when prices are going up and wages are going up, that's when you get inflation, right? So what we saw there is a cooling in the hourly earnings. The 3-month average on that is now at 4.1%, which is obviously off the highs and kind of below what expectations were. So, on that side of it, it's good news. And then probably more importantly, we've obviously seen over the year, I would say we've seen the hourly earnings start to moderate, but we haven't really seen the same kind of momentum on the labor force participation rate and people coming back to the labor force kind of post-pandemic. And
Matt, just to quickly interrupt, just to give people the data on that. So the first quarter analyzed rate for wage growth was 6.3. Then went down to 5.4. Third quarter is 5, and now fourth quarter is 4.3. So that's what the Fed would be looking for.
Right. Yeah. This is all the stuff that you want to see. And then, a driver of the labor market and the drive of wages is lack of workers. There are fewer workers available. You have to pay more to who you're able to get, and labor force participation ticked up to 62.3, which is great news. And within that,
well below where we were before the pandemic started.
Yeah, on the labor force participation rate, that's a component where you can't just think about the economic dimensions of that, because that's the point where you start to get into demographic aspects too, right? So you think about labor force participation rate, and historically, from kind of call it the 1970s through to the 2000s, you had a very ever increasing labor force participation rate, in part driven by increasing participation of women in the labor force. Post financial crisis, that really kind of dropped as you started to see the effects of a baby boomer generation start to move into retirement years, and a labor market and a kind of structural demographics where we're just an older society. And so from pre-pandemic to now, it's hard to, it's on some level not surprising that the labor force participation rate won't return to the levels that we saw previously, but we definitely want it getting more robust in the context of kind of the wage pressures we see.
Yeah. So when you look at the trajectory we were on before the pandemic in terms of the size of our economy, the size of our labor force, we're still significantly below where we should be, even though we've created 1.2 million jobs or rebounded 1.2 million jobs from the lows. But if you look at where we should be in terms of the amount of people in our labor force, the unemployment rate would be more like 5% rather than the 3.5% it is right now.
Yeah. So
but I also not sure that that's the correct way to look at it. As Matt was saying, you have the baby boomers retiring, and I think the pandemic may have accelerated that. So I think a lot of the people that have left the workforce might never be coming back, and we just kind of have to deal with what we have right now.
Yeah.
Right. So John, Brendan, tell me, we started on this a little bit, but how is Powell and the Fed reading this jobs report? We saw the minutes come out this week. I mean, there seems to be a pretty strong commitment to their approach to raising rates and not wavering on that throughout most of the year. But how are they looking at this, and how are they viewing it?
Yeah, I think the market's reaction has been very positive on the assumption that this is, this is a very Goldilocks report. It is showing that the labor force is, that basically labor markets are still robust. They're not cracking. And at the same time, the signifiers of wage pressures are going down. And that is on balance, exactly just as we said, what the Fed wants to see. And so that is unlikely to change their mind one way or the other. The risk going into this was that, you'd get a significant muscular upside surprise in jobs. We saw an upside surprise in the ADP, the privately compiled ADP jobs number that came out yesterday. We saw a positive surprise, fewer unemployment claims on a weekly basis. And there was a sense that, you could get a magnificently large jobs number. And then the Fed would respond to that by becoming even more hawkish. And this is at a time when the Fed's projections are well above, the median projections are basically well above where Fed fund futures are projecting rates to go. So we've got the Fed, saying we're still in tightening mode, in determined tightening mode. We're going to be hiking rates, that rate need to go up. And the markets are basically telling the Fed, you got 2 more 25 basis point rate hikes in you maximum. You're going to top out at 5% or thereabouts. And then you're going to start cutting in the second half of the year because you've already overdone it.
And that's a really important point, John, because some Fed, governors are still talking about hiking 50 at the next meeting. This wage data does not justify that at all. If anything, it justifies them pausing right now. If they don't want to cut, I think the best thing they can do is stop being so hawkish.
Yeah. I mean, there's no chance they cut next time, right?
No. They would have to be cutting in the second half of the year because they slowed the economy. But now they actually have a chance to have that Goldilocks scenario where we have, a slowdown, but we also see inflation continuing to keep dropping, but we don't have a large recession.
I mean, we've talked about it several times when I've been on the show and several times when I haven't, but Powell has set out for this soft landing. We keep seeing these kind of reports that maybe he's going to pull this off. And if we do have a recession, it'll be very shallow and very short, and we'll move into an environment of cuts, in the later half of this year. But I mean, what's your read on that? Am I right on that, or are we just still chugging along and may hit the brick wall pretty hard, pretty fast?
Well, there's the communications that the Fed has engaged in over the last few meetings have been a little bit garbled, and they look particularly weird when put up against their economic projections. And there's a lot of mismatch and discontinuity when you look at all this, and it leads one to believe that. The Fed they seem to be very serious when they're telling the markets, look, we're not cutting in 2023. And, if there's a hard landing, that's just going to be part of the process. Sorry, everybody, but in controlling inflation is job one. And if there's one lesson we learned from the Volcker era, it's don't ease too early. And that's the message they're trying to send for the medium to longer term. The market does not buy it at this point.
Right.
And so
the 70s saw wage spirals. That was a big component of why inflation was so high. And I think the data that the 2022 data just showed you, we're not even close to a scenario where we're going to see a wage spiral.
Right. And the Fed, that's over the medium term, longer term guidance. The near term guidance is we are still going up. They're barely able to even countenance, that inflation is going in the right direction. And this is to some extent, I think a lot of the market
open up the door that maybe who his last speech was saying the exact opposite. We're so far behind the curve, we have to go to 7%.
Yeah,
and now he's flipping in the opposite direction.
Well, there's
some of this depends on how you define soft landing too. I mean, I think that's I would argue that in retrospect, the pandemic recession was a V-shaped recession, but there was lots of kind of like, I don't know, depends on the industry you're in, but there was a lot of debate about that at the time. I think that in retrospect, we probably will see a soft landing. It may not feel like that for certain people or certain industries, but
some sectors.
Yeah, John and I were talking about that the other day, where the U.S. economy is just so much different than it was in the 70s and 80s, and it's much more dynamic. So certain parts of the economy, like housing, are already in recession, but that doesn't mean the entire economy has to behave the exact same way. You could see very strong pockets and also very weak pockets.
Yeah, right. I mean, I would argue that there are, as the numbers have come in and the situation has improved and gotten better, that there's been a bit of a dilution of like soft landing means no recession. And I'm not sure that I don't really buy that. I don't think that that's kind of where this lands. But it wouldn't surprise me if if we end up with a technical recession this year that, depending on sector, isn't that bad or isn't that long or what have you. And I mean, the other thing that it is jobs day, we haven't really touched on this in depth, though we've talked about it before, is the degree to which the scar tissue of the tight labor market of the past is leading employers, broadly defined, to really focus on retention, even maybe at the expense of margin or wages or whatever. And that is a structural support to the broader economy that is not to be discounted.
A lot of the gains in corporate earnings have been, they were able to raise prices, but their input costs didn't go, so their margins expanded. So a lot of companies have a lot of margin to play with before they have to start laying off people. Where we saw the problem was the tech sector thought that the pandemic was the new normal and hired as such, and we're seeing them decrease. But the rest of the economy did the exact opposite. They planned for a nuclear winter,
Yeah, and that speaks to the broader point that this is a labor market like we've never seen, right? Never. And that when we look at all the uncertainties around it, how this labor market could behave completely differently versus history to a recessionary dynamics. But you've also got like the data confusion. There was a report from the Philadelphia Fed late last year that said that the BLS, the early look back and benchmarking, they dramatically overstated job gains in the second quarter. There was a lot of head scratching around that. There's more homework to be done on that front, but it just goes to show that the landscape is still very foggy here. And
Don, I'm actually glad you raised that, because I would say that, having tracked Jobs Day for a while now, is that it does feel like BLS is running into some of the same survey problems that have made lots of headlines in political world. Just I think the sample
totally
size
logical is too,
Yeah, it makes sense. I mean, it's kind of, it's something, it's no knock on them. It's just it's getting more difficult to reach people and survey people, but it does have implications for how you kind of look at the data and think about the data in the broader economic context.
Great. Let's take a quick break there, and obviously a lot more to cover. We'll come back and talk about some things that may throw a wrench in all these plans. But you're listening to the Macrocast. We'll be right back after this break.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at PentaGRP.
Welcome back to the Macrocast. Bryan DeAngelis here, hosting this week, and as always with John and Brendan from Market Policy Partners and my colleague Matt McDonald, president of Penta. I want to shift gears a little bit into the political world, but we'll focus how this may have some pretty major implications for the economy going forward this year. We're sitting here Friday morning. We still have no Speaker of the House. We're on day 4, and by my last count, I believe vote 12 coming up soon. Really, not unsurprising, but pretty jarring, scene this week as we've seen about 20 members of the far right side of House Republican caucus hold up Kevin McCarthy's potential job as Speaker of the House, and really no end in sight, and a ton of negotiations going on. But we'll see if today or over the weekend anything breaks. Guys, let me throw it out to the group first. I mean, I have some thoughts on this, but how are markets reacting to this yet, or are they mostly enjoying the show for now and worried about what this means later on?
I don't. Yeah, whether markets are enjoying the show or not, it's a little hard to say, because this does, as entertaining as some might find it, it also flashes forward to the kind of dysfunction that one might see when something really consequential, not that this is inconsequential, but something even more consequential is on the line, as you said, the debt ceiling. And, the idea that this is a little bit of foreshadowing for a deadlock that could really put markets into a spiral is the concern. It's a little bit remote, the debt ceiling. It's probably, it's a moving target. Nobody really has a perfect feed on exactly where it's going to attach. And so it's sort of a spring summer kind of thing. So the markets aren't, immediately threatened by this risk. But political uncertainty is going to be a theme this year around and centered around the debt ceiling. And this episode, at least, on its surface, seems to highlight that, that can be a real challenge this year.
I mean, there was obviously a lot of anxiety heading into, this Congress around the debt ceiling. And there were conversations and efforts during the lame duck of do we try to tackle this now with, one party control and get this out of the way. And even to his maybe credit, Kevin McCarthy was even foreshadowing that of like, take this off the table so we can fix this now. John, I want to get to your point a little bit. I mean, it is hard to nail down the timing, but where I have, a lot of concerns is we may hit a perfect storm next summer of debt ceiling, government funding, and let's not forget the political backdrop of around that time. You'll see the 2024 presidential race really heating up, which always makes Congress a little bit more effective. And given the muscle flexing we've seen this week, I mean, there's no doubt in my mind we're going to see a pretty major fight over the debt ceiling, a pretty significant delay where we get into that process where we were before of, a government shutdown, questioning whether we can raise it, questioning whether America is going to default on its loan, and that's going to have serious ripple effects to the economy.
I don't want to sound like a Pollyanna, but you can take this disorder that we're seeing on Capitol Hill potentially as having a silver lining. One being that it seems to have galvanized. Obviously, Democrats are showing a lot of unity behind Jeffries with their group. This is a galvanizing moment, potentially for Republican moderates as well, who are increasingly estranged from the far right zealots in the party. And there are a decent number of Republican GOP House members who are representing districts that Biden won, right? And they have a very small majority, and so it's not going to take a whole avalanche of Republicans to change sides to get something through in terms of a debt ceiling fix. And this disorder is focusing minds. Everyone is now looking at that and saying, okay, well, we've got to prepare and lay the groundwork for a solution on this front under those circumstances. So it's possible that this, as bad as this looks for the GOP and Kevin McCarthy and House functionality in general, maybe it sows the seeds of a smoother process to get through the debt ceiling.
Color me skeptical.
I don't know.
You're right. I want Matt to jump in here too, but for our audience, I mean, you are right that there is definitely a scenario where what's known as a discharge petition, right? That if enough Democrats and enough Republicans sign on, they can kind of override basically the speaker and skip the rules committee a little bit and bring a debt ceiling bill right to the floor. This is where I have to be honest about my own party too. I don't know that Democrats are going to do that right away. I think they're going to let Republicans really mess this up. I mean, Biden's up for re-election too. So they've enjoyed this show this week, and Biden being out there kind of on the trail, talking about his accomplishments with a split screen of Republicans fighting with themselves, threatening our U.S. economy is something Democrats are going to want to play on cable news for a while before they maybe come in and save the day.
Listen, you need to, on some level, you have three competing interests as you think across this kind of broader debate in the debt ceiling and in Congress in general. You have the interests of the country, you have the kind of party interest broadly, and then you have individual interests, right? And the reality of the weakening of institutions over decades now is that the hierarchy of those interests are probably more inverted than they've been in the past. And that is not to say that individuals don't care about the country. I'm sure they do. But even when you look at the McCarthy vote, is that these holdouts are doing individual fundraising on their opposition, and they are making money on it for their campaigns. So there are very few, as you've seen with the negotiations, there are very few kind of levers that the people in charge of the institutions have over the individuals who are obstructing this. And then to look at, you would have to believe that, okay, say that there are individualists or there are institutionalists among the Democratic Party who would join with institutionalists among the Republican Party to fix the problem of Congress. Let's be clear on what the debt ceiling is. It is agreeing to raise the debt for the money that they have already allocated. They already made the decision. Yeah. I mean, the inanity of it is worth pointing out. But I would say on that side, I'm skeptical of that too, because you had the example on that side, and the problem there is you had the Democrats playing in primaries supporting people who they were accusing of election deniers to strengthen their hand in the general for party gain. So nothing about kind of recent behavior of and incentives across the political spectrum would lead me to believe that kind of the fever is ready to break in terms of kind of the practicalities of governing.
Yeah, I think that's right. And it's a good point on the priorities being inverted. I mean, that is exactly what we're seeing. We are seeing in these negotiations, individuals, not only the fundraising, but they're negotiating their own committee assignments, which are mostly on financial services committee. So will also have a big impact on probably a lot of our listeners in terms of putting some folks in those seats of power. It's about getting on the rules committee, which for the audience that doesn't understand the rules committee, that basically sets and controls the whole agenda for the House floor. And it is designed in the speaker's favor with usually a 9-4 split where the speaker has plenty of votes and the opposition party just gets to kind of, it was once described to me as just lob bombs into the opposition and try to mess it up, but really moves things forward. If McCarthy is forced to give up even 3 of those seats to this group, then now we really do have those 3 factions where he's completely removed the power of the speaker to set that agenda. We're going to have the Rules Committee is going to become a household name in the sense of every government fight, every appropriations fight, certainly the debt ceiling, before it even gets to the floor, is going to have a huge public fight right there. And that's going to I can just see the tickers now. I mean, we're going to have weeks of those fights before we even get to a point where, to Matt's point, we're starting to put country first and actually get to a solution.
Yeah, I mean, I think, on some level we've, there's been lots of writing on this, but we've reformed our way over many, many years of kind of emasculating the parties and leadership in the favor of, empowering small this or small that. And, here you have, these are empowered small people with small constituencies. This is what it looks like.
John, I will go back to your point again on the record as very, very skeptical, but I do think you do raise a good point where at the end of the day, I think after a fair amount of pain, you do have somewhere between 10 or 12 Republicans in very, pro-Biden districts that will have to, I mean, they may be making a choice, as we saw back in 2008 for several folks, of like, I'm going to make this vote and it's going to be my retirement from Congress. But, they're in New York, they're in New Jersey, they're in a place where I think some of the major economic private sector drivers could still wield some influence and educate and help them understand. The challenge in this environment is that's also a dwindling number where, the traditional lines of the Republican Party being supported by big business, et cetera, just doesn't exist anymore. The far right hates big business as much as the far left. So this isn't like we saw with Boehner and others, where the chamber or other folks can come in and start flexing some muscles and move some votes. In many ways, it's an allergic reaction to that approach now.
That's a good point. This is a Republican Party that has changed enormously since that last era. Yeah, for sure.
Yeah. I'll make a final note, which it'll be interesting to see what happens after we publish this episode. But it goes without saying, I don't think this is a McCarthy problem, right? I don't think if McCarthy ends up dropping out and Steve Scalise or someone else comes in, I mean, these problems don't go away. It's the same dynamics as Matt was saying earlier too, of you've still got this group that is going to put self first, party second, country third. And I just don't want to give our audience false hope that, okay, if we switch up the speaker, maybe we've fixed this with a Band-Aid. I don't think
that's wrong, but I'm not. I mean, let's be clear. This literally happened to Kevin McCarthy previously.
Yeah, it did.
So
it did, yes.
I don't, I mean, notwithstanding kind of my prior comments on the structural issues of both incentive and the way that we have kind of structured our institutions and weakened them over time. So I don't think the problem goes away if Kevin McCarthy goes away, but this is not, I mean, this is not the first time that he's had issues getting over the line with leadership.
These 20 are definitely, give or take one or two. I mean, it's about 10 looking for real government reform, and it's about 10 that just don't like Kevin McCarthy.
Yeah. And his margin is what? 5?
4, yeah.
So that's tough.
He needs 4, yeah. Yeah. And that's the big thing. I mean, overnight, we saw a lot of these negotiations, but I guess my point is, if a Scalise comes in, he doesn't back up to powerful speaker who can whip the vote and get the debt ceiling moving through no problem. He's still going to have.
Yeah, I think that's fair.
Control.
That's fair.
Right. Well, a lot more to come on that, and probably more updates in the weeks ahead. But Brendan, why don't we shift outside of the crazy political world? What else can we expect next week, and what are you guys looking forward to?
So next week on the data front, we get the consumer price index. So that'll be we got their wage data. Now we'll see what the consumer prices are doing. And then one thing we didn't mention, which was really interesting going on in the world, is the reopening of China and how they're dealing with the COVID situation, because they've had massive outbreaks because they just went from literally lockdown to free for all. So I think that would be an interesting topic to discuss next week.
Great.
Yeah, the big questions around whether China's, obviously accompanying this big opening is a stimulus push by the government. We're loosening things up on the side for property developers and so forth. Next week, we're going to get credit aggregates, which are a decent indicator of whether this stimulus push is really gaining any traction. Chinese equities and assets have had a really good bounce since their October multi-year troughs. I mean, they've been in a very, very dismal downtrend and weakening trend for a long period of time. They've gotten this bounce on the idea of reopening and stimulus at the same time. Whether that actually is borne out by the outcomes in the real world remain to be seen.
Right.
God, I wish I knew what the conversations were in the room among Chinese leadership over the past stretch of all this stuff. I mean, it is really, it is fascinating to watch this, because it does have this quality of, I don't know. I mean, it is like the leadership messages coming out of this are like national level gaslighting in terms of the pivot from how important it is to shut everything down to, it's fine. It's fine. I mean, it's been a wild transition, and it's not on some level, on a macro level, they had to rip the Band-Aid off at some point. So I don't know that it's like, I mean, they probably could have had a different or better vaccine strategy, but at some point you got to kind of deal with the world as it is. But it is wild. I mean, it's really crazy.
Yeah, and it's really hard to get good information about what's actually happening and the disruption that might be happening in the factories, not because of shutdowns, but because of illnesses. So it's lots of uncertainty and questions about that. But also next week, corporate earnings reporting starts. The mega banks kick it off with the unofficial start on Friday, and that is going to be a consequential moment, as a lot of the concerns for this year for the equity market are around the earnings outlook. Whether a slowdown, which is the consensus expectation, is going to take a bite out of earnings the way it has historically, and whether equity markets can begin to try to find their footing even with that dynamic ahead of them.
Great. Well, lots to look forward to, and hopefully by then we'll have a Congress formed and have more insight on where that's going to head. But let's leave it there for the week. Thanks for everyone for listening to the Macrocast, brought to you by Penta and Markets Policy Partners. You can check out more of our episodes online, and as always, please like and subscribe wherever you get your podcasts. Follow us on Twitter @PentaGRP, and everyone have a great weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.